Gave up managing billions to become a better investor. Episode 29, Some Journey. Hello. Yes, it's Tuesday, another podcast day. It's week 6 of the corporate earnings season. Still a few things going on, but not too much. Certainly not as busy as 2 or 3 weeks ago, but some things to talk about probably at the next podcast when we've had some of the interesting numbers coming out on Wednesday, Thursday, Friday. Markets have been a little bit volatile, but that's par for the course during August, I would say. A little bit of volatility, some bits and bobs of news flow. I think the most interesting thing to talk about, and what I really wanted to say today, was about the fund management survey. The Merrill Lynch fund management survey, always an interesting moment. Something which I used to, in a previous profile, used to often talk about at length each month, trying to work out what the average thoughts and the average fund manager, or at least the average person replying to the fund management survey at Merrill Lynch, was thinking about life and allocations, where they were going to put their money, or maybe where they weren't. And my usual rule of thumb was actually to do the complete opposite. Not the complete opposite, but sort of this notion that if fund managers are already exposed in a certain way, then maybe the next iteration is they change those views. You know, they decide to sell stuff rather than hold it. They decide to take some profits, or alternatively put some money into something which they currently don't own. And I always used to find that quite useful, really, because markets look forward. We know all of that. And given that markets look forward and factors are already priced in, or to some extent anticipated, when changes start to occur, you can sort of get some different unanticipated shifts and moves. And I used to always quite like looking for things that are out of favour, which perhaps could become a bit more in favour in due course, and was that factored in or anticipated fully enough, etc., and vice versa. Of course, the reality was that a lot of people were gaming the survey to some extent in any case, because a lot of the this sort of positioning, the where are we exposed kind of declarations, were themselves a sort of an anticipated what is the fund, our fund, the fund that the institutional fund a person was running was going to do, not necessarily what they were actually doing today, but what they were going to do at some near-term future period. So itself, the timing, the insights are sort of not perfect, but they give a good insight. And I enjoy the fund management survey. I always learn something from it. Anyway, what does it say today? Just a few headlines, really, just a few thoughts over a few minutes. And the most obvious ones are that I believe in terms of the perceptions towards a recession, they once again have become less likely. No great surprise there. We've talked in a previous podcast about the fact that the IMF numbers have improved. Certainly perceptions versus many global market movements, which were given probably in the fund management survey and many other general investor surveys at the start of this year for full year 2023, were rather more pessimistic, and they've had to sort of, in this sort of halfway point, sort of 8 months or so into the year, starting to sort of, people are starting to change their views and opinions. So no great surprise there. And the fund management survey is doing that classic sort of switching away from previous positions to more sort of conventional ones. So no surprise there at all. Also interesting to see that the bearish view, and of course there are still some people who are bearish, cautious, holding cash and related, that general perception has now gone back to levels last seen in apparently February 2022. Now, that is sort of interesting itself, because of course February 2022 was that moment, you may recall, is after all only circa 18 months ago or so, was kind of when we'd kind of gone through those 2021 markets where, despite all of the uncertainties and difficulties of generally often deep COVID lockdown periods, the perception towards markets, and not so much global economies per se, but the opportunities that markets were perceived to be giving, were quite firm. You may recall that 2021, after all, was the year when, in hindsight, a bunch of very silly IPOs occurred. didn't really participate in any of them myself, not really my bag, but I know plenty of people did. And when you look at market movements, market share prices on a lot of those stocks that were IPO'd in 2021, when you look at them today, there must be a lot of embarrassment among certain brokers and the like, perhaps some fund managers who made some interesting decisions. Anyhow, but that wasn't the case in February 2022. There was still relative optimism. The fact that inevitably it's what you often get, isn't it? After a good year, there's the perception there's going to be another good year. And okay, that sometimes does happen, but sometimes it doesn't. And I myself entered 2022 with a bit more caution, particularly actually towards some of the areas that were rather beloved. And it was interesting how, of course, 2022 worked out. Negativity in many market indices, a poor year, particularly for the tech sector, which obviously is very important in certain markets, and of course a poor year, very poor year in government bonds, general bonds as well. So it was kind of interesting that we kind of got back to that point in terms of people's kind of perceptions towards the backdrop, which is interesting. That's a good insight for the fund management survey. I like that. I like the fact that people have kind of become more comfortable. Now, of course, what you're saying is, well, hang on, didn't you just mention 5 or 10 minutes ago that August markets have kind of got a little bit more volatile, there's a bit more uncertainty, VIX index is up, and of course all of that is absolutely right. And, this usual kind of slightly illiquid August, bit of uncertainty out there, ups and downs, bit of vol, a bit more vol, is all very normal and consistent. But of course, you've got to remember, fund management survey, be it the supposed actual allocations or perceived future allocations, or however people, undertake their survey results, they were largely put together during late July. And late July was that wondrous, you may recall that corporate earnings season back then, it was good. And it was useful. Stocks were coming out, sectors were coming out with good performances. We talked about it in the previous podcast. There was plenty of opportunity out there, and there still frankly is. You can understand why people's fund management survey reactions were relatively positive. But there you go. Other insights, just some brief ones before I finish up. Inevitably, perception towards the tech sector is apparently the highest level since late 2021. Well, that again is a reminder of what we've just been talking about, that we've now got back in the broader tech sector to sort of that end of a good year. Things are all right. Things are good. Things are opportunistic. It's so important. The rise of AI, the rise of the machine, the rise of technology continues apace. And there are, of course, a bunch of truths in that. But I come back to my notion, and again, you may recall that I talked at length about the fact that I've top sliced some of my long-held Alphabet position. And even though I've bought some shares in some other technology companies, Alibaba, I still think is cheap, as we talked about last week. I bought some more shares in PayPal, slightly different sort of technology company, certainly not as trendy, but well known, and I think actually undervalued, even though the last set of numbers were taken poorly. But that gave me the opportunity to buy some more shares. Actually, not quite as cheap as I got my first lot, which I bought at circa $60. But hey, low 60s, I think, is still an attractive price. We shall see whether that's true over time or not. But the thing is, it still seems right to me that the average fund manager, the average allocator, the average investor should actually be saying that there are a bunch of other sector and interesting things out there. And when we get to the end of the corporate earnings season, maybe I'll do it on Saturday, or maybe I'll work it into the next couple of podcasts. We'll talk about what are the sector conclusions from this earnings season. How should people be investing for the rest of the year? Because don't forget, the second most important time for fund managers to give insights and previews and thoughts and everything else is shortly coming up. It's that kind of September back to school period. Obviously not as important as the either side of Christmas, start of the new year kind of view. How is the new year going to progress? But that back to school reaction, insight, thoughts, that is so important. People have come back from summer holidays. We've had the end of an earnings season, a bit of volume markets and everything else. what's the last 4 months of the year going to bring? And more importantly, of course, for broker types is what can we get, our customers to kind of be excited about. For us boring fund managers and investors, I guess it's more what should I be doing, if anything, over the next 4 months? And of course, for some people, it might be, well, I want to make sure I don't lose money now because we've made money. Whilst for others, it's I've got to make money because I haven't made it so far, etc., etc. But these are things to talk about as you move from late August into early September. I always find it a fascinating time. All I would observe, though, is that the Fund Management Survey, which also actually talked about, before I forget, great insight on the REIT sector. REITs, if you like, property and related matters, apparently were at their lowest general allocation since the time of sort of late 2008. Yes, you know what that means. Global financial crisis, I guess the infamous, famous, in my opinion, Big Short sort of period, ironically about various matters to do with housing and property and related. But hey, a great film. If you haven't seen the film, you really should watch it. Fabulous book as well. But there you go. I find it that interesting. The Fund Management Survey has identified that. I guess that would mean for some people there is a buying opportunity there at some level. Must admit, as I've talked about before, my general views towards property and related is that most individuals have way too much exposure there already with things like their home, matters like that. But there you go. I could see how some investors could actually be finding opportunities rather than threats in that space. And, I guess if I take a step back, there are certain parts of that kind of broadly associated area which I find mildly interesting. It's not a big allocation for me personally. I've frankly, as we've talked about before, found a bunch of other sector and individual stock selections in many different areas which are frankly much more interesting than REITs, property and related matters. Anyway, we shall see how all that goes. All I can say is that, and the reason I called today's podcast Some Journey, because the thing is, that's the Fund Management Survey for you. It's not telling you what to do. It's telling you how people themselves are kind of investors, respondents, etc., themselves on an investing journey. And you've got to try and work out whether you kind of run with them or are trying to do something completely different to them at all. And we get back to, and this is something from a very early podcast, talking about misdirects and insights from that in the much earlier part of my career. And the one I keep on coming back to is the importance, the need to know more than 90% of the market. And I know that sounds, and I said it back in the podcast at the time, I know that sounds impossible. How on earth can I know more than 90% of the market? Believe me, it's not as difficult as you think, because the thing is, you've got a bunch of market participants, followers, day traders, thinkers, strategists, whatever, doing a whole load of things which then get influenced by what everybody else is doing. And whilst that might be right on day 1, possibly day 10, possibly even day 110, eventually it won't be. And that's what makes the investment world interesting. And that's why I've always personally found my hot period, my sort of where insights and thoughts and conclusions kind of work through most positively. It doesn't tend to be today or tomorrow. Few people can be super smart day traders. I guess some people are, but it's certainly not me. I found that time period to be more like the sort of 6, 12, 18 month period. And these are the sort of times when I think about earnings season, when I think about factors that I've thought about over recent times, that's when you get those thoughts running through 6, 12, 18 month period. So as always, I kind of think that kind of looking forward view, but hey, soon we'll get to that back to school period, time to give a few more insights about what the rest of the year is going to bring. But as always, whilst we might be talking theoretically about the rest of the year, the reality is you're actually already talking about next year, possibly even a bit beyond. But hey, that's the exciting world of investment and related. Just a quick podcast today. I say back on Saturday with some thoughts on this week's corporate earnings insights and anything else that's kind of interesting or occurred in an interesting fashion over the interim period. But hope you enjoyed that. I hope everything is going well. Thanks again for listening to the podcast, and speak to you soon. Goodbye.